Hey guys, Freaky Finance here. Last week we looked at Bell, and this week we're going to look at Aberdeen Asia Pacific Income Investment Fund. This is a different asset class than we normally look at. So normally we look at equities. Today we're going to look at fixed income on the bond side, specifically in emerging markets. Bonds are a little bit different, and one of the things I like about this fund from the get-go is that it's emerging markets, and it fits the macro theme of a devaluing dollar and strengthening of some other emerging market currencies. Moreover, it helps diversify the portfolio, as I don't own very many fixed income, and I also don't own very many foreign equities. So as you can see here, the company's objective is to maintain the current income and achieve incidental capital appreciation from investment in long-term debt securities. You can see here a lot of funds trade at a discount if they've been negative historical performance. This fund does. You can see here the NAV is 4.11, market value 3.07, therefore discounts 25%. Though we're not looking at this just for closing of the NAV, because that can persist for long periods of time, though it's likely some of it will continue to close. But here you can see the market distribution rate out of their fees, so NAV distribution rate. So you're getting a pretty good yield here, 7% a year. So it is a pretty high yielding fund. It is emerging market, so obviously that should give you some idea of the credit risk involved. But when we go a little bit deeper, this is just our latest fact sheet from the end of October. You can see here the discount to NAV was a little bit higher, 28%. The fund has performed a little bit better. Market price is now over $3, right? It's closed a little bit. The NAV since inception last year has been great. The last 3 years have been fairly poor for the company. Probably the most important thing on this fact sheet for us is just this currency exposure versus geographic exposure. So with fixed income, you kind of want to make sure a lot of the debt is in the local currency, as when governments keep printing money, it's a lot easier to pay off your debt if it's in your own currency. Versus, say, if it's denominated in American dollars and say you're Indonesia and you have an issue, you're still going to have to pay in US dollars. So, you keep printing Indonesian money, and assuming you print more than what the Americans are printing, your dollar is going to go down more, and you still have to pay back in the US dollar currency, and it kind of hits you. And it can make these long tailspins, think like the Turkish lira or Argentina. So, quite a important risk there to manage, and so you always got to look at that. So one of the things I look at here is you can see currency exposure at 31% for the United States, but only geographic exposure is only 5%. So that tells me there's at least linearly thinking, this isn't true, but it gives you an idea that there's at least 26% of the bonds that are emerging markets that are denominated in US dollars from a bare minimum perspective. And you can see that they have some key positions in India, Indonesia, and Malaysia, as well as South Korea and China. On the actual geographic side, you can see it slightly even more. So you can see 17% in India, but only 12% of the local currency, which means some of the debt in India is denominated in American dollars. That's how I'd read these two. We're going to go into more detail about the actual currency risk because I downloaded the holdings as of October 31st. But the only other thing I want to point out here, we'll talk about this in a second, is there is leverage involved in this fund. They borrowed about $70 million on assets at 204. So the total assets is the two together, the aggregate, so $274 million. I'll talk about the covenant in a second, but basically it's you need $3 in assets to every $1 in debt, and the company actively manages that. So if the assets go down in value, they have to pay down their leverage facility on a 3-to-1 basis. You have your interest expense from the actual leverage, and then you also have the management expense, 232% total, including the interest expense. The modified duration here is 5 years. Basically, when I look at two things that drive fixed income investments is your interest rate risk and your credit risk. Obviously, with emerging markets, you're taking on credit risk. Duration risk is something you could manage to either through interest rate swaps and stuff like that. Basically, the longer duration, the more sensitive the asset will be to a rise in interest rates. So as interest rates rise, bond prices fall, and as interest rates fall, bond prices rise. Other key drivers here is you're going to notice some of the coupons when we go through some of the holdings are quite high, which means the sensitivity to such movements is actually lower because the coupon is steady. It's the fixed income part of the for income investment. So we'll talk about that in a bit. So a lot to go on. year by year returns, you can see it swings quite a bit. So more importantly, after the great financial crisis, you can see that this fund performed fairly well for the last 3 years after that, and then it kind of oscillated. So it's negative, positive, positive, negative, positive. So that's something to keep in your back of your head. But I like it as a diversifies the portfolio. One, because it's a different asset class than what I normally have, and two, it gets me to places that I'm able to get into as easy. For Americans, so FAP was a ticker for the Canadian side. FAX is their kind of equivalent, and the holdings are not the same. You can see just right here the discount's not the same, so there's less of a value play, if you will. But that's not necessarily the investment thesis. It's just a margin of safety to lower the prices when you get in. The more upside potential there is. Let's jump into the holdings first. I downloaded the data for October 31st, but here you can see the top 25 holdings, and I just did some little color coding here. So you can see here they have a key position, Indonesia, specifically sovereign debt, so government debt. We have the banks here, but it's Indonesia government bond, and it's credit linked with American bank. However, here you can see the local currency, so it's denominated in the local currency, which is nice. Of a percent of the fund, 13.7%. Now I want to say the percentage isn't out of 100. It's out of 129% or so. And that's because of the debt part of it. So it's kind of weird to think in your head, but think of this as these four holdings are 13.7% of 129%, not of 100%. So anyway, you can see they have Indonesia exposure, some Mexican exposure, the local currency as well. The Malaysia government is a newer one that I saw them pop on slowly over time. It's about 8% now, being a third. India exposure, so unlike the other two that we've talked about that are color coded, the green and the Indonesia one, purple one is not sovereign. It's actually the banking sector in India. HDFC, so the housing, it holds 30% of another holding that this fund also holds, so specifically India housing, and then a lot of banks. So we have the third largest bank in India, Axis Bank. We have the large mortgage lender in India, second largest house finance company, India Bulls Housing Financing, and then HDFC Bank, India's leading private sector bank. That's your typical, when I go to the website, it's your typical bank offerings. Then you have another multinational bank. So overall, those five equal 10.33% of the fund. Then you have these kind of, I think, like these are tactical allocations to specific currencies. Then you have these like 2% of the fund to this, 2% of the fund to this country. So you can see this fund is not afraid to go to places that we normally wouldn't get access to, which is what I like to see, because it means that I'm not going to be overlapping it with anything else in my portfolio. So you can see here you have Ukraine, Nigeria, you have Ivory Coast, so West Africa. You have this newer one to the Brazilian. This one's actually denominated in Brazilian dollars, so these four were actually denominated in US dollars, which is a risk and from a sovereign debt perspective. So I just denote that with red. Pakistan, you have Colombia, but that was the local currency. Kazakhstan, this one's actually going to expire. And, well, today's December 12th, so 2 days. So on Monday, this thing's going to mature. And you can see these coupon rates right here are pretty high, like 10.5%. Expires 2030, so 10 years from now. Well, 9 years from now in a bit. And 10% here for the Brazilian real. 9.5% for Kazakhstan. So quite high coupons, and the high coupon helps mitigate the interest rate risk in my view. It just makes it less sensitive. It doesn't, like, duration is a better way to do that. You just lower the duration. Lower your duration is less sensitive it is to interest rates as well. But the higher the coupon payment, the less sensitive it is as well, because the primary driver is the coupon and not the premium or discount over the life of the bond, right? So anyway, quite a lot of holdings. So 25% of the holdings equal 55.8%, and of that, it's out of 129%. So quite a lot of, pretty diversified, I guess, when only top 25 holdings are only 55 of 130. When we jump into local currency exposure, which I think is the more interesting one, you can just pop this to the pivot of the actual data. This is you can see the same 5 holdings again. This is India. You can also see they have some additional holdings. I didn't make the top 25 list. And overall, it's 16% of the fund is denominated in that currency, the local currency. And Indonesia, you have the top 4 that we already picked up on, and Malaysia. So those are the key currencies and geographies they're playing in. However, on the fact sheet, we did see China and South Korea as well, but you don't see the currency exposure here. So it's embedded in this. And you can see this is denominated in US dollars, but you can see down here you have quite a lot of China companies. And you'll see a lot of South Korea companies, Philippine companies, Hyundai. So quite a lot of China Construction Bank. And these are all 1% positions. So 1 million here, 1 million here. So it's fairly diversified. And it pays a pretty good dividend yield. And that's what got my attention. And in my long-term view of, say, American dollar slowly weakening over time as it continues to print more money, and say these emerging markets being more able, not all of them, but some of them being much more able to handle the virus, it should lead to some currency appreciation in emerging markets. Then that will help this fund. At least that's my view. And that's one of the reasons why I'm looking at it. So here, if I jump into just their quarterly statements, you can just see that their China holdings, they also break it out for us. But again, most of these are denominated in US dollars, but it gives you more of an idea of exactly what bonds they're in, like what coupons they're in. So at Baidu for 0.8% coupon, so lower coupon. It's a more well-known company. You can see 8.5%. I didn't point out the ratings because I'm not a big fan of ratings, but they claim 54% of assets are B, investment grade or better. You always got to take that with a grain of salt when something's yielding over 7% in a low return world. Chances are, even if it says it's investment grade, it's probably an illusion. So you got to actually dig into the numbers and see. Don't get me wrong, this is well diversified, but I mean, when you're getting paid 7%, usually there's some risk involved, especially in this type of interest rate environment. With that in mind, some of these countries aren't in the same interest rate environment as the Western world. So China, for example, can still lower interest rates, which would be a boost for fixed income assets. Whereas in America, when you're already near the low, there's very little more upside in holding fixed income instruments because you can't lower interest rates, which would increase the bond yield. And so one of the things that I'm looking at here is, well, how can I still get that partial hedge? So basic portfolio theory, what Markowitz and business schools will teach you, is that when you're supposed to have an allocation of bonds, because when equities decrease, chances are the federal government's going to react by slashing interest rates to help speed the economy, right? Because usually the equities are crashing because of the economy. And so they lower the interest rates, which the bonds, one, they pay fixed income, and two, they're going to increase in appreciation if interest rates are lower because their fixed income coupons look more attractive, right? Say if I'm making 10%, but the market rate's 10%, it's not a big deal. But if the market rate goes down to 5%, but I'm still getting 10% for 10 more years, this thing's gonna look really attractive, right? And that increases the value. So that's how you should think about bonds. And one of the things that's hard now, and at least where I live, in the Western world, you don't get that same interest rate pickup anymore, right? It's the asymmetry is there. Like, unless you expect a lot of negative interest rates to keep going more and more negative, there's not a lot of upside at 0.25% risk-free. So I look at something like that, and this looks even more attractive relative to that opportunity set. So I like this company, or this fund rather. I do want to point out here that I do own it. Not a huge position. Picked it up a little bit late. I saw it go down to 2.5, and I didn't buy it till 280 pretty much. Now it's at 307, so it's performed okay. You're getting 8.5, but you got to remember the fee. But right now it was 8.8, and then it's picked up 9, so about 17% on the year for this one, which isn't bad. But obviously some other things have outperformed in our holdings. But this is a different type of instrument, right? It's a diversified fixed income bond play, so it doesn't have the same. It has risk, but it's not the same as, say, my Cloudflare play or some of the other riskier equities that we've been in over the last 9 months or so, or 6 months since this channel started anyway. When we jump in, I do want to point out the leverage. So that's a risk whenever you have a leverage in a fund. So this one, the covenant is 300% asset coverage, which again is $3 in assets to $1 in debt. And that means if the assets fall, they have to reduce the debt to keep that ratio constant. And they've been doing that actively. So that means during the crisis, when net asset values were falling, because a lot of these things aren't very liquid, this company got hit pretty hard because they're technically a forced seller, right? When you have leverage and you have a covenant that's 3-to-1, and your assets are going down, you have to sell assets at distressed prices to pay down your leverage. And so in that case, leverage is not good on the downside. But on the upside, it is good because it magnifies your return, right? So that's a risk here to point out, just anybody that sees it. It's not crazy. It's not like a 300% debt to equity or debt to net asset value. It's the other way around. It's $3 in assets for every $1 in debt that it's mandated to. So that's why the fund is out of 130%. Whereas, say, some of these horror stories where you see where the debt is 3x the assets, that's literally it. You're at $3 in debt for every $1 in assets. So it's a totally different beast. But this is not without its risk, nonetheless, and I wanted to bring that up. They do have the leverage facility, and that does add to the interest expense, which does eat into the returns of the fund, as you can see here. These are the annual reports, so you can see primary driver, interest income, then you have these large swings in the actual performance of the investments themselves, and they have their interest rate swap contracts to try to reduce the duration, I would imagine, or increase it, but I would imagine most portfolio managers have been reducing their duration. Unless, say, they expect an interest rate decrease in some key areas, but most have already decreased them, at least in the developed side, right? But say you don't know that in the emerging market side, right? What if China decides to decrease interest rates more, and then you actually want the duration so that you get more of a pickup? But anyway, I digress. You can see the investment structure. You have $2 million in investment management fees here, and then down here you have your interest expense from the leverage of $3.6 million. So that eats into it, right? That's $5.5 million total for those two lines. And technically the interest income was only 20 million, right? So it does eat into it. And then you have here the main source of value. So you get the fixed income, but you also get the upside from the capital appreciation swings. And so in 2020, this thing got slammed, so that's why I looked at it, that's why I bought it. So do I still think there's upside? Yes. I mean, the net asset value is over 4. It's currently trading just over 3. So you have some margin of safety. But the NAV can widen or close. Lately, it's been closing steadily over time. But this could easily go back down, right? So the net asset value by itself is not a catalyst per se, but it just gives you that extra margin of safety. I do want to point out Bridgewater, a company that I follow. They have a lot of free research on their website. And this is just something to point out how these type of countries oscillate over time and why you don't want to just have, say, a home bias. So, say, if I'm American, I have 80% of my fund is, or 80% of my portfolio is American, right? Canadian, the same idea. You kind of want to have some exposure everywhere. And so that's what this kind of points out over time. So you can see here, 1960s, the winners, so ESP, losers down here, right? 10 years later. America up 41, down 17, and then it's up 96, and then it's up 217, then it's down 27, and that's up 237, right? And then what, USA is going to go down, and then these lender performers right now, China, Brazil, Korea, going to go back up, right? Is that it's kind of what we're oscillating? You can see Canada, Russia, and Australia, so those are all commodity plays as well, or more emerging style developed countries, I guess is the right way to word it. Because technically they're developed countries, but they have a lot of exposure to commodities, right? So in Canada, you have oil, you have gold. It's big parts on the TSX, right? Energy. Russia, energy. Norway, energy, right? Australia, you got a lot of mining. Anyway, that's what I'm thinking. That's why I kind of want some of this exposure down here. So I've been buying into some other ETFs for China, but this one isn't strictly a China play, really. It's only 10% of the fund on this. Yeah, 10% of the currency, 12% of the fund. So it's not like a bet on China, but it has China in it, and I like that. And it has India in it, I like that. Indonesia in it, I like that. Malaysia, I'm not that sure because I'm not that familiar with the country, but it looks interesting on paper. I can't say if I like that or not because I don't know enough about it. You can see that it just gives you some extra diversification across the world, and that's what I'm after. And you can also see that this thing has been pretty downtrend for quite some time. They did make a shift, so they were more Australia focused. Then they made a shift into higher risk things, and I don't think a lot of people like that. Ultimately, for me, it works out because I got in after COVID, right? That was my punch when I saw the dividend yield just go crazy high. I was like, well, I think I'm getting paid to take the risks. That's why I got in. And I still like this, even though I'm up 10%. I think this can close, right? Like you get 350. And you're still at a discount to their NAV, which is 4. So It's interesting, but you can see how it reacted in the Great Financial Crisis. Just the magnitude went from 660, and you're hitting pretty much where we are, a little bit higher. But yeah, that's pretty crazy, right? And then it bounces right back, and that's during the commodity cycle boom as well. So I'm looking for something similar, maybe not the same magnitude, but even if that doesn't happen, this capital appreciation side, I'm still getting that coupon from these higher yielding emerging markets. So overall, I think the opportunity is attractive and it fits into the opportunity set of my portfolio. I'd like to know your thoughts on it. I know bonds might be not as attractive or sexy, I guess is the right word, as equities, but I think everyone should have some exposure to different types of asset classes and different types of assets around the world. So anyway, I'd like to know your thoughts and have a great rest of your weekend.